My money right now is optimized for building wealth and enjoying life. And so in this video, I want to show you how I am doing that. But really, this will only work if you and I have similar goals. And so I want to start with the what and the why. So first things first, what am I optimizing for? I'm actually optimizing for a net worth of 3.5 million. And this is investable assets. So my home does not count by 60. Okay, like when I retire. And so if I hit it earlier, great. If I don't, that's okay, right? But 3.5 million investable assets by 60. So this would be like stocks, bonds, real estate. Why am I doing it? Well, it's because I want to give the people I love the life they deserve. That is my mission, to help others as well. And if this resonates with you, then keep on watching, because I think I figured it out. So what will this video give you? Now, this video will give you a full list, I'm not holding anything back, of everything to optimize. And I will also give you my opinion on priorities, how to prioritize. Now, here's what I won't do. I won't give you exact numbers. Like, I won't tell you, hey, you should be saving X amount of money every single month, because honestly, that is different for every single family, for every single person. But what I can promise is that by the end of this video, you will have a list of every single thing you need to think about on how you want to allocate your cash flows, okay? And I've split this into a nice acronym, GOAL, okay? You can't ever forget it now, it's a nice acronym, GOAL, it's an actual word. And so there are really only 4 things we can do with our money: G, O, A, and L. And we're going to go over each of these 4 things, as well as the subcategories under them. Now, there's a framework for thinking through how we should optimize each of these 4 things. But if I went over all of that, this video would take hours. So I'm just going to give you the high-level overview. Okay, let's get started. So the first thing we want to optimize for is giving. And giving is defined as anything that solely benefits others. So buying your wife a new television that you're also going to watch is not giving. Okay, sorry to say. And so what does this mean? What categories do we have? We can give to a charity or a church, right? Now we can also buy gifts, right? Whether this is getting something nice for your wife, right, or your husband, right, so spouse, or child, right, getting them something nice, right, or just like a friend or a colleague, right, even like buying them a drink or like treating them out for lunch or something like that. So like all of this would count as giving. This is the first category that you want to think about, how much you want to be giving. The second category, O, stands for O, okay, and this is anything you have to pay that will increase your net worth. And so this is all the money you owe, right? So this is going to be another word in accounting, we call this liabilities. And so this would be like taxes. If you owe taxes at the end of the year, that's the arrow should point this way. This would be your mortgage, right? Paying off your mortgage increases your net worth. Consumer debt. And so this would be credit card debt, car loans, personal loans. And so your mortgage also includes a HELOC. If you know what that is, if you have one, then you have one. If you don't, it's okay. This is debt, right? Tax liabilities. Money that you owe. And usually money that you owe comes at an interest rate that is way too high. And so usually this is highest priority. You want to get rid of this first. And so I guess in here would also be student loans. You want to get rid of those ASAP. Now, there are other ways you could use to decrease the interest rate that you're paying, debt consolidation, but we won't go into that today. We just want to go over a list of things that you want to think about when you're trying to build wealth and optimizing your cash flows. The third option is, so you can accumulate wealth, and what this is allocating money towards anything that compounds in value. And so the difference between this and owing is that paying your debts off will increase your net worth, but they will increase your net worth by the amount of debt you pay off, right? Whereas accumulation will grow your net worth and let it compound. It will take advantage of compound interest. And so what is this? This is really, it's investing. And so within investing, we have stocks, we have bonds, we have real estate, we have insurance slash annuities, and lastly, we have alternatives. And so an example of alternatives might be crypto, even though I don't like counting that as something that will grow wealth personally, but some people do, right? And so this is the primary vehicle that we're going to use for wealth building: stocks, bonds, and real estate. But this doesn't really take off. The effect of it isn't really that material until you get rid of all of this debt. And so to put things into perspective a little bit, $1,000 per month invested in an S&P 500 fund for 30 years will give you a 7% return per year. And so this is already inflation adjusted, which means we're getting rid of the effects of inflation, so inflation doesn't matter. This combination will give you $1.1 million. Now, it's very possible to do this within tax advantaged accounts so that when you withdraw money from this $1.1 million, everything is tax free. It's very possible. And so if we want $3.5 million, which is, well, my goal, right? The number I want to hit is just $3,000 a month, right? So if I'm able to save $3,000 a month and keep everything else the same, I'm actually going to get like 3.4 something million dollars. Yeah. And so that's my goal. My goal right now is to every month save $3,000. And so we talked about giving, we talked about the money that you owe, we talked about accumulation, and so now we talk about the last one. Living is our last one. And living is any spending that benefits ourselves. And so there are, again, a few categories. So category number 1, future spending. And so this would be something like an emergency fund. And so with an emergency fund, we can have like a 1 month, we can have 6 months, we can have 10 months, right? So for example, my wife and I right now, we have an 18-month emergency fund. And so first of all, why do we split it like this? Well, the 1 month emergency fund is for like real emergencies that you want to be able to pay for without it disrupting your existing cash flow optimization plan. The 6 month really is there for bigger expenses, like for example, medical expenses, or you total your car or something like that, right? But it comes after having the 1 month, right? The 1 month is like the highest priority, it's the most important. I would say that the 1 month emergency fund is even more important than paying off all your debt, right? If you don't have a 1 month emergency fund of like a month's expenses, getting a month ahead, I would prioritize this over paying off your debt. And the reason is because things are gonna come up that will throw you off. And once you're thrown off, it might take you several months to get back on track. This month emergency fund is something that you will build as you pay your debts off if you have debt. If you don't have debt, then, well, you can directly build a 6-month emergency fund. The end month emergency fund is directly related to how long it takes to restore income. And so I know I'm getting into like how territory, but this is so important that I do want to get into it. And it's quite compared to like teaching you how to optimize your investments and 401ks and IRAs and how to pay off debt and all that. This is kind of important. So let's talk about the how. How long it restore income. And so for me, I'm a teacher. And in the international education space, teachers are hired on 2-year contracts. And so the worst for me that can happen is I start a school year and then something happens and I can't work anymore. And so it will take me it will take me 12 months to find another job, because that's when the next school year starts. Now, I wanted to give myself a little bit of a buffer, and so I said 18 months, let's go, 18 months. And so right now the emergency fund is at 18 months, right? But realistically, it might take me 12 months to replace my income. And if I take 12 months to replace my income, my new income might not be as high as my current income. And so that's where the extra 6 months of emergency fund comes in. Yeah. So that's kind of the idea to keep me on track so I can hit all my other financial goals, even if I don't have a job. That's kind of the idea. That's what the emergency fund is for. And so the first category of future spending is an emergency fund. Now, a lot of people put emergency fund under accumulation. I don't like to do that because I'm planning for a rainy day. One day, I will spend this money in case of emergency. And yes, I'm going to put this money in a high yield savings account. That's going to pay a few percent, but that's just bonus money. I don't count that towards wealth building. The second category of future spending is going to be big purchases. So if you're buying a car in the future and you're saving money every month towards that car, that will count as future spending, right? A fixed amount that you're saving every single month. A vacation, same thing. A house, however, is not under future spending. Do you know why? It's because a house counts as real estate, and real estate compound in value. And so if you're saving towards real estate, I will keep that separate under an accumulation account. I would categorize that under accumulation. And so, great, we have future spending, but we also have current spending. And so I categorize current spending as spending that I will incur in the next month, right? And so with this kind of spending, it will be split into fixed spending and discretionary. And so fixed spending is around the same every single month. The obvious ones might be something like rent, utilities, subscriptions, right? And for example, if you have like a pet and you know you buy the exact same amount of pet food every month, then that would go under fixed, right? So pet food. But really, anything for which you can reasonably estimate an amount for will go under fixed. Even things like heating or electricity, which I know more electricity is used during the winter months, but if I know the average amount, I would still categorize that as fixed. And so the cool thing with fixed expenses is you can put them all on a credit card, right? You just set them up. So this would get paid on a credit card. Now, I'm talking a little bit more about the automation side of things, but let's keep focused on the optimization. And so what to optimize? Your discretionary expenses could be things like clothing, restaurant meals / food, entertainment. And so since we talked about credit cards over here, I like to put discretionary spending either on a debit card or just keep it in cash. That way I'm more cognizant. Now, here's the thing. If you do this properly, your fixed spending is fixed every month. Yeah? It's fixed, right? You kind of know the amount. So this is fixed. What else is fixed? Well, if you're saving $1,000 a month because you want to be a millionaire in 30 years, then investing is also fixed. If you're paying off debt, right? These are also fixed payments, right? A mortgage is also a fixed payment. This is intentional. So you can literally set an amount every month, 10% of your income or 5% of your paycheck. This is also fixed, right? And so what's really interesting is most of your cash flows, after you've optimized them, right? After you set your financial goals, after you figure out which accounts are the best to use and how much to put in each account, you can actually start automating all of this. And you can take advantage of behavioral science so you don't self-sabotage your own plan that you set. The only decision that really requires your attention are these discretionary spendings, which is great because this is the fun stuff, right? What movie to watch, what clothes to wear and buy, right? Which restaurant to eat at. Like that's the fun stuff, right? So you can literally set up your life in a way where you're only making decisions on these discretionary spending, and you're just coming back to your fixed spending, reevaluating once in a while to see if these amounts are optimized. And so this is the first part of financial automations and becoming a financial freedom self planner is to optimize everything that can be optimized so that you can automate those things afterwards. So if this is something you're interested in, then stick around, pay attention, maybe even shoot me a message and ask some questions. I'd be happy to answer you.